Hey guys, let's get right into it here. Here's a solid dividend value stock I've come across. It's Target. You all know Target, so no need to go through what the business does, but here are some quick highlights that I thought were pretty noteworthy. Mm. The board approved to buy back $8.6 billion worth of stock in 2026. There's a high dividend yield of about 4.56% that you can see in the picture here, which is a nice little payout we can take while we wait for this stock to correct. And it's a good time to buy with the stocks being near 52-week lows. More on this technical aspect later in the slideshow. So what's going on with Target stock price? It's down 21% in 6 months and 39% on the 1 year chart. Some people are saying go woke, go broke, and that kind of does seem to be the driver. There seemed to have been significant backlash in the form of boycott from recent Pride collection, which has deterred customers and shareholders. The current CEO will be stepping down in 2026 and replaced. And the new CEO, who started out as an intern, which is actually pretty interesting, his name's Mike Fidelki and worked his way up to CEO. So where does really Target go from here? I think that they need to stop being woke and tend to the core customers and shareholders and less reliance on their private label goods as well. They also, I think it'd be important to reduce the retail theft, which has accounted for 800 million to 1.2 billion in 2024 alone. And, weather the storm that's coming, that is tariffs. Target's not a growth company by any means, but it's stable cash flow and it's cheap right now, 10 times earnings with 4.6% dividend yield. Target being at such a bargain, you can actually look back and see that it's never lost its 200 monthly moving average, which it first started recording back before 1990. It's been tested several times and has always made a higher high next, as you can see by the yellow line below, and always bouncing off of it. I believe it'll happen again here. So what about Target's most recent quarterly performance? Q2 was an improvement from Q1, but overall it's still trending downward. As you can see, net sales are almost down 1%, comparable sales almost down 2%, same store comparable sales down 3.2%. Not very motivating, but you can see they're starting to move in the right direction as compared to Q1 2025. And there's just that statement in red from Target management saying they're committed to regrowing the company and reversing these negative growth rates. Now that Target stock's below $100 and there's a PE of 10, just the valuable real estate they alone could unlock a lot of shareholder value. If Target can start to claw back some of their customers here, we can see real improvement in the stock price. I can see here in the model 2025, they have 106, everything's in millions here, so 106 billion here in revenue and 4.47 billion in free cash flow, about 4.2% free cash flow margin. Going out projecting 5 years from 2026 through 2030, I'm growing revenue at the analyst consensus of -1% in 2026 and 2% in 2027. I'm going to hold that constant through 28 through 2030, and in the terminal year, just at 2%. Going ahead with the free cash flow margin again at the analyst consensus of 2.5% in 2026 and 2.7% in 2020. And I'm growing it by 0.2% a year all the way up to 3.6, which is still under where they are in 2025. So I think these are pretty conservative assumptions in my opinion. Using a mid-year convention, if you don't know what that is, you can look it up. But basically, 1 divided by 1 plus the interest rate raised to zero point 0.5 to account for a company receiving money, evenly throughout a year. 8% discount rate is what I feel comfortable for a company this size, and taking these conservative measurements already on the revenue projections and the free cash flow projections yields the sum of the free cash flows of 72 billion. Adding 4 billion of cash, which they have, or really subtracting it's just to get the net debt here, and the 20.3 billion of net debt gives us an enterprise value of 88 billion. There's about 454,000 shares. That is not in millions. and that would give us a target price of $194, just about 193.96. It's currently trading sub 100 on 99.24. It's under that right now at about 93. A margin of upside of almost 100% plus. So just spot check ourselves. We can do a real quick comparable company analysis with companies in the industry. Uh, so alongside Target, we have Walmart, Costco, Kroger, BJ's, and Dollar General. Just looking at valuation metrics from left to right, we have EV to EBITDA, market cap to levered free cash flow, price to sales, and then we start to have forward-looking multiples, forward price to earnings, forward market cap to free cash flow, forward free cash flow to yield, because this takes into consideration, the growth and expected increase in earnings. Then I like to look at, the revenue growth over 5 years, everyone's the last 12 months free cash flow margin, last 12 months revenue, EBITDA, projected EBITDA for the next 12 months, and then how big the company is overall in size with enterprise value. And then I like using, my own little metrics you can calculate to the right, just EV to revenue, EV to EBITDA, and next 12 months EV to EBITDA. Right here I'm selecting next 12 months EV to EBITDA because I'm kind of want to project even with the downturn with -1%, to show you Target's really at a bargain here if they can redirect their consumers and get back their core consumers and win them back here and just show modest 2% growth, and start to return to normal multiples in the market. So you can see EV to EBITDA in the multiple market here for the last column. I'm showing an average of 17.14 with a median of 13.4. Obviously, Costco at 32 times multiples the outlier. So say the median of 13.4 is more fair. Let's just be ultra generous and take the average of 13.4, which is the median, and the low of 8.03, which is the multiple for Kroger. We get a next 12 months EV to even a multiple of almost 11 times. Times that by their anticipated 8 billion times next earning gives us an 86% implied enterprise value. Net debted out with the debt and the cash, and we get to about 102 billion, which is about 454,000 shares, like we said, and the target price would be about $224, and the net price now is about $99 with a margin of safety of over 100%, all while yielding a nice dividend for the waiting for the correction.